Hey guys, it's Chase with MoonShot Money. As many of you know, we are real estate investors and have been for over 20 years. Real estate investing has been very, very good to our family. We own apartment buildings, self-storage buildings, commercial properties, a 119-space mobile home park where we own many of those mobile homes, a resort property, and of course residential properties and farmland. We live in Northeast Tennessee and we're currently experiencing very elevated real estate prices. And the four states where real estate has been skyrocketing the most are Tennessee, Texas, Florida, and South Carolina. As investors, we look at all asset classes and try to find opportunities where prices are depressed rather than elevated. We actually had a great opportunity this year to buy a 12,000 square foot medical building where we run one of our businesses. We captured a lower interest rate and got a very good price per square foot. It was an unusual opportunity that we couldn't refuse. That doesn't happen too often, especially in Tennessee. Our real estate investments have done extremely well over the years, and we tend to buy more when the prices become more acceptable. In the meantime, we're looking at something in the stock market called real estate investment trusts. We would appreciate if you bump that like button down below as well. It helps the channel so much. Subscribe if you like what you hear. REITs are companies that own or finance income-producing real estate across a range of property sectors. These real estate companies have to meet a number of requirements to qualify as REITs. Most REITs trade on major stock exchanges, and they offer a number of benefits to investors. REITs allow anyone to invest in portfolios of real estate assets the same way they invest in other industries, through the purchase of individual company stock or through a mutual fund or ETF. The stockholders of a REIT earn a share of the income produced without actually having to go out and buy, manage, or finance property. Most REITs operate along a straightforward and easily understandable business model. By leasing space and collecting rent on its real estate, the company generates income, which is then paid out to shareholders in the form of dividends. REITs must pay out at least 90% of their taxable income to shareholders. In turn, shareholders pay the income taxes on those dividends. So, if you ever wanted to invest in real estate but were reluctant to become a landlord because of the perceived headaches, REITs might just be perfect for you. We want to spend the rest of this video telling you about a REIT that we've been investing in for several months now. That REIT is MPW, Medical Properties Trust. As of this filming, MPW is under $17 per share and pays a great dividend of 7%. Plus, over the last year, the price has been reduced by almost 20%, so we always like a good sale every now and then. This Birmingham, Alabama-based REIT is America's second largest hospital owner, with about 46,000 beds at 438 facilities in 9 countries, but primarily in the U.S. About half of their properties are acute care hospitals, and the rest are a collection of behavioral health and inpatient rehabilitation centers and urgent care clinics. As a benchmark, over the past 20 years, MPW has outperformed the S&P 500. Here are several reasons that we're buying more shares of MPW. Like food and shelter, healthcare is one of those absolute necessities, especially when it comes to hospitalizations and acute care. Baby boomers are only going to increase that demand as they continue to age. REITs that specialize in retail space, office buildings, and hotels might be considered risky at this point. We feel very confident in hospitals and medical properties. No matter how high inflation rises, people will still need hospitals and medical treatments. People may quit shopping so much, staying in hotels, and they might not return to the office after the pandemic, but hospitals will always be needed. The management of MPW is growing revenue at a steady pace and seems to be pointing towards sustaining their 8 straight years of dividend increases. We love dividend increases. Medical Properties Trust enjoys the ability to raise the price of occupying its properties. Its 52 operators are bound by triple net lease deals in which the operator is responsible for maintenance, insurance, and taxes. We love triple net leases. MPT is also an active producer of investment capital to many of its tenants and can be counted on to raise the interest rate on financing when it can. Cash on cash. Then there's the wonderful dividend of 7%. REITs are required to pay at least 90% of their taxable income to shareholders, and paying dividends is a long accepted way to help publicly traded companies keep shareholders interested, especially in inflationary times when securing income can seem an easier path to profitable investing than chasing growth. Our growth portfolios have really had a bad 2022. MPW is currently paying 29 cents per share per quarter and $1.16 per share per year. Pretty sweet. There are a few more benefits of MPW before you go. Liquidity. If you own physical real estate, then you know there is not much liquidity there. Everything changes with a REIT. It's just like owning stock in Amazon, Apple, or Microsoft. You can sell the real estate with simply the click of a button. We love the liquidity aspect. Then there's the diversification you get with a REIT. We just bought a medical building, as we mentioned earlier, but with MPW, we have many hospitals and many hospital beds making us money instead of just one building. There's great safety and diversification. If you like the idea of owning real estate, a REIT might just be what you're looking for. Hey, we have handpicked another great video for you right here, so stay with MoonShot Money, and I'll see you in the next one.